Mullen automobile stock has been trending in popularity as of late, and a lot of people are wondering if they should be buying more, selling what they have, or standing on the side and wait for better entries. As the market is very volatile at the moment, we should be mindful about which positions to pick, as well as their individual exposure and timing. Over the past few days, the price action of Mullen has brought the stock to around $1.21 before stabilizing around $1.42. Mullen is an EV manufacturer that is relatively small in its scale of operations, and certainly in its earlier stages when it comes to actually being able to manufacture and provide vehicles to end users. Meanwhile, the stock reflects the ongoing hope, fears, and hype that the shareholders are expressing through their decisions to buy, sell, or hold the company's equity. Overall, the company expressed a very clear sentiment from the market that the glory days of EV stock, when any company pretending that they will be making any sort of alternative energy vehicles will enjoy the gravy ride, are long gone. It seems like nowadays, the capital has found a new safe haven in both fixed asset yields, metaverse NFTs, and cryptocurrency trading and staking. I think that from a fundamental perspective, the company does have true potentials, and the market is unwilling to send the stock to much lower levels from where it is at the moment. And at some point, it's difficult to push the stock price lower than the floor. The question is where the floor is exactly going to be. My game plan is to start following up closely the price action of Mullen over the next couple of days and to wait for the support to actually hold there for at least 3 to 4 days. And then we have to see whether the price will actually move up before considering that the timing may be the right one for the entry. Now, let's also take a look at the technicals of the stock. The trading volume of Mullen has recently been 42 million shares versus the average volume of 65 million shares. Over the previous 52-week period, the price fluctuated between 52 cents and $15.90. The market cap of Mullen Automobile is currently at $450 million versus the enterprise value of $397 million. The difference between the market cap and the enterprise value is the premium or the discount the financial market is willing to allocate to the company based on the current fundamentals, leverage, and market sentiment. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts, then the assets value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statements, so it's less reactive than the market cap and often more lenient as well. One key element to note about the enterprise value is that for many growth-type companies, one of the most significant assets they own is the goodwill. Goodwill is an expectation of the market that a company can generate more profit or grow faster, because it may have a better management team, a stronger brand recognition, and a bigger online following. It's what makes this company unique compared to the competitors. In other words, it's not a tangible asset that companies can necessarily use. It is, however, often the reason why some companies are perceived to be trading at a discount, as the market cap is lower than the enterprise value for those companies, and because the enterprise value is less reactive in volatile situations as well. If the company goes to liquidation, the goodwill would be gone, and we're going to be left with far less assets to distribute among shareholder and debt holders than the number on the balance sheet. When we compare the current price to the historical price fluctuations, the stock is 6% higher than the 1-month low, 145% higher than the 12-week low, and 145% higher than the 52-week low. On the options market, which often gives us a hint on the market sentiment on where the stock price is likely going to go next, the implied volatility is 213% versus a historical volatility of 137%. The put-call volume ratio is currently at 0.4. It's normal for many stocks to have a higher put option volume than what they deserve because many institutional investors hedge their positions by buying put options. The most recent volume of options traded is 12,000 contracts a day versus the 30-day average of 15,000. For the open interest, the most recent volume of open interest has been 344,000 contracts, compared to the 30-day average of 412,000 contracts. In terms of its shareholder structure, institutional shareholders own about 0.6% of its outstanding shares. The biggest shareholders include Vanguard, BlackRock, and Jackson Wealth Management. It's relevant to understand the shareholder composition of a company because this can help us to determine if you should be holding the stock long-term or to trade the stock short-term. If the stock is mainly held by retail traders, this may be a sign that the stock lacks the depth to justify long-term trust from shareholders. The consensus is around 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. There's obviously a lot of exceptions to this because there's a lot of great companies mostly held by retail as well, but that tends to be the exception and not the rule. The current short interest is 15% of the total float and 31% of the transactions coming out of dark pools. Usually, if the short interest is above 15% of the total volume and a significant portion of the short coming out of the dark pools, there would be potentials for a short squeeze. Overall, I would recommend to have a position in Mullen in the upcoming weeks, assuming that the stock price manages to hold its ground and bounce back from there. Remember, we don't have to aim for the exact bottom. We just have to find the overall period of time when the stock and the sector begins to recover, for which I believe that it's going to happen within the next 2 or 3 weeks. I would recommend to commit between 1 to 3% of your portfolio's capital in Mullen. And I would also recommend to split this allocation in batches of 20% at a time so that you can purchase more in further retracements. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.